Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office TV. My podcasting platforms are Apple and Spotify, and to my members who get my most direct access and a lot of different benefits of SFO continuity, welcome. I am very much looking forward to today's program, and it's been an active day for me as this will be my second of somewhat of a back-to-back discussion. And very simply, the title today, and I think it kind of says it all, even if you're a multi-billionaire, are 15 stocks all you need? My special guest today is Maneesh Shanbhag. He's the co-founder and CIO of Greenline Partners. So the big picture in setting the context for today is, are we overcomplicating investments, even at the family office level? Could 15 carefully chosen stocks be all you need outside of cash to build a robust portfolio? And here's the key: that outperforms complex and often illiquid investments. So we're going to dive into why some of the world's wealthiest families, investors, SFOs, and family offices in general, outside of their residences and cash positions, choose to only focus on the value of completely liquid and transparent. Many of you heard the interview that I did with Nathan Troutman, who advised literally 3 of the wealthiest families to ever walk the earth on their family office. And although it wasn't actually, that was a conversation on directly investing in private companies, but we both laughed and chuckled maybe half an hour in and say, yeah, we each know multiple billionaires that simply and are pretty darn happy practically only investing in relatively an intimate number of public companies. So on that note, as we begin with our 15 stocks all you need, Maneesh, welcome to the show.
Thanks, Angelo. Good to see you.
And to give the audience a little bit of context, I've known Maneesh for probably about 10 years. We haven't connected since before COVID till I proactively reached out a couple of weeks ago. Back in my old incarnation years ago in my podcast, he was a guest and he did a lot of the heavy lifting on some papers that we published about this subject. So he's been very consistent and has been on it a long time. And again, as I'm an active allocator and investor, and I don't perfectly agree with his assessment, but I'm willing to be maybe 80% plus on board. So let's see where it goes. Why don't we start, Maneesh, with you? Say simplicity is the key to portfolio management. Can you elaborate?
Sure. Yeah. So let me add a little color to this idea. What is a simple portfolio, and what is a simple portfolio for different families? Because you had a great interview with Leon Cooperman, and I listened to it, and there was something that he said that I thought was really powerful. Where he said, "Look, when you have a lot of money, it's your money. You can do whatever you want with it, and there's no one right portfolio for every family, but there can be a great simple portfolio for every family." And so that's what I want to talk about today. So for example, you could be a family that says, this whole investing game, it's not how I want to spend my time. We either as a family don't have an edge in a corner of the market, or we don't want to hire a team and build that edge. So then if that's the case, the smartest strategy for you is going to be a simple portfolio of index funds. Don't waste the time on trying to build out stock picking or a portfolio of hedge funds or private equity. If you have a few ETFs of index funds, stocks and bonds diversified, you're going to be good, and you'll probably outperform 90% of your peers. Another way to think about simplicity, though, is simple really means focus. And so that can mean a small handful of stocks, as Angela alludes to in the title of this interview, but a small handful of private deals. It doesn't have to be all public, but basically a small handful of positions that you understand deeply. And through that portfolio construct, you're diversified enough, but not over diversified. And I'll get into that in a second. And through that, you get this, what we call the compounding benefits of simplicity, right? So when you own a focused portfolio of positions, you have transparency, you have control. Through those two things, you have a clear picture and forecastability of cash flows, of taxes and tax forecastability, which is something we hear family offices complain about all the time. Hey, I have no idea what I'm going to pay for taxes because I don't get my K-1s till August or September. Huge complaint. And through all of those simplifications, you can have a smaller team, so less headaches, lower costs, all that. So there's all these compounding benefits of having a focused, simple portfolio structure. But I'm just going to add one more piece to this, which is it's nice to know, hey, here's what a great simple portfolio construct looks like. It's just as important to know what is a terrible portfolio construct. And to us, over diversification with high fees is the absolute worst place you can end up. So, one of the things that we're always reminding ourselves of and clients is keep it simple and avoid the big mistakes. It's easy to think that when you see the headlines that some of the great investors were made by some big bets or some big calls that they made. But the reality is the longevity of a Buffett and Munger or some of the other greats really comes from all the things that nobody talks about, which is repeatedly avoiding the big risks and the big mistakes. And to us, the single biggest mistake we see time and time again is that over-diversified portfolio laden with fees and lack of transparency and risks. So, for example, if you were a family that held 30 plus hedge funds going into 2008, you learned the hard way that portfolio went down a lot with equities and it didn't help. And you were stuck with a portfolio with tons of fees, tons of taxes, and no control. And the same thing is true today. We see this all the time. Families with 50, 60 plus different private equity fund investments. And we're now saying, oh, wow, this has not kept up with public equity markets. What do we do? That over-diversified private equity portfolio where we're paying 3, 4, 5, sometimes more % in fees is going to kill you, especially now that valuations are higher. So I'll stop there.
No, that's very valuable, but there's a lot to follow up on. So I'm assuming in the work and advice that I do with single family offices, I could make the argument, some executives may get mad at me, but I'm just bringing it up as a discussion point that when you're simplifying your portfolio that is liquid and transparent in quote unquote public companies, and let's say it makes up 80% plus of your portfolio, you have not just a simpler tax picture that you described and great control over it, you also don't necessarily need a large team or staff.
That's exactly right.
Whereas if I'm investing in tons of private credit, direct companies, earlier stage companies, real estate, all could be awesome, by the way. We're going to debate and go through that. But there's no question that is not as transparent, definitely not as liquid. If you're an LP, you're arguably taking on counterparty risk in certain ways. And very simply, if you believe in control, unless you're literally a direct investor with controlling interest, I admit you don't have pure control over a public company as well, but you have absolute control to get in and out of it as quickly as you want. So there's a degree of control. You basically don't need the level of team that you would have in a more complex portfolio. But here's where it gets a little interesting, Maneesh, and you probably have some of the math to back it up, but let's see. Why do you believe that this approach can outperform a more complex portfolio, active, broadly, market average in private company, private equity, venture capital, real estate, etc.?
Sure. Yeah. So, this is, it's interesting. When John Bogle started Vanguard, I was reading an article just the other day where he said he was never a believer in this idea of 100% market efficiency. The reason why Vanguard and index funds work was this very simple math. It had nothing to do with market efficiency. It was just the simple math of once you are diversified, if you are diversified with a whole bunch of active managers, and you're paying 1 or 2% or more in fees, you will earn the market return minus those 1 or 2 or 3% in fees. While in index fund, you own the same market, roughly speaking, minus basically no fees. That's the reason why index funds succeeded. The same math is true in hedge funds and private equity. All right, so we've seen this in hedge funds. Basically, if you own a diversified portfolio of hedge funds, what you have, like if you look at the broad hedge fund exposure, the 4 trillion or so in assets that are in that space, what you own is a portfolio that has the same, call it beta or market volatility, as a portfolio that's something like 50% equities and 50% cash. And what you're going to earn from hedge funds is basically that return of half the market, 50% stocks, minus fees. And now, like, it's one thing to say the same thing is true in private equity. 30 years ago in private equity, when you could buy a family-owned business at half the public market multiple, hold it, maybe improve it, and then take it public at twice the multiple, you could earn a 20% IRR. But if you are buying a business at the same multiple as public markets, paying 2 and 20 on it, there is no way you are keeping up with markets. And so that's the problem with a diversified portfolio of private equity. Like you said, Angelo, there are going to be good managers, there's going to be good deals inside the portfolio. But if you're over diversified, you basically you own a share of the market, and owning the market, because private markets they're just businesses like public companies. And if you're paying the same multiple, you're going to earn basically, by and large, the market return minus those fees. That's the simple math.
Yes. And earlier today, I had a debate where I took the approach of being an active direct investor of controlling interests versus a gentleman who's a partner at a private equity fund. One of the stats that came up was by Hamilton Lane, a well-known outfit and researcher as well. Now, they picked a 20-year window that did help them a little bit, but I believe it was 2002 through 2022. They were showing private equity returns net of fees of about 14.6%, and they were illustrating the S&P ballpark at about 9.8. I argued back, where am I right, where am I wrong? First of all, that would not be as good in the last year or two, so maybe it's selective on their part to kind of leave out the last 2 years. But could I make the argument, besides no liquidity, so besides the liquidity issue, which is a very, very big one, strictly based on, is the illiquidity premium worth it? In that example, it sounds like on the surface, for some families, it might be. But not that I'm cynical. I'm just saying, let's dig a little deeper. First of all, Buffett spoke about this relative to how we're tracking the math, mark to market. That would be one question. How about this one? Survivorship bias. How about the funds you're not talking about that went under and you didn't roll them into your averages? And the other one is a little, some would argue, nefarious, but not everyone's perfectly honest. There also are honest mistakes that are made. And in the accounting, which is very private, it's not public, do you really understand the counterparty risk and what's going on? And one other one to try to poke a hole in it, maybe I'm doing your job for you, Maneesh, and that would be related to the survivorship bias. I know this happens in hedge funds. Suppose I'm below average and I don't want to report. Therefore, it's being somewhat selective in terms of what it's reporting. Am I exaggerating things, or if anything, am I about right or being a little bit too nice?
No, look, I think it's exactly like you said, Angelo. I think you just did my job for me. But, I'll give you the perfect example is, there was that book, maybe it was 20, 25 years ago, Where Are the Customers' Yachts? And I mean, us as a family office and ultra high net worth advisor and manager, we see a lot of portfolios. We see a lot of families come to us after their experience with hedge funds and private equity and saying, help us simplify. And the only place we've ever seen great success in private equity was when you were the manager, not as the limited partner. And so it's simply the fees kill you. And I think, all the reasons that you pointed to in the data, with the data are correct.
Yes. And again, I know the industry doesn't like to talk about that. Most family office people are too nice. This helps when you're effectively non-conflicted like I am. Maybe unlike in the past where I could have open and honest discussions. And damn it, sometimes I'm just flat out wrong. And I want to be called to task and I want to learn. But hopefully this is one of the things that makes me a little bit unique in the industry. Uh, you mentioned, I think it was actually Charlie Munger who kind of relative to that quote, not making mistakes is more important as an investor than being smart. Now, he might have been a little tongue in cheek in that. But yeah, I guess if you're not making mistakes and you're a long-term investor, and even then you have liquidity, could I make the argument, Maneesh, and maybe this is a lack of discipline, but if I'm an LP or ineffectively privates, well, now more than ever, I have secondary opportunities, but I'm going to take a hit and it's not instantaneous. But it almost forces me to be kind of in the market, where if I'm looking at the portfolio, it's relatively simple and straightforward. Am I going to be a lack of discipline or think I know better where I could start to become an active trader and it doesn't work out so well?
Yeah, fair. I think maybe one of the things you're getting at is, should there be, is there a behavioral benefit to private equity, or something that smooths your return profile? And we've definitely heard that argument. But I'll tell you, when you read the basics of behavioral finance on the internet, it makes it seem like the market conditions or the event you need to help your clients and family offices prepare for is the big drawdown, like the next '08, the next COVID crash, and so on. But when we work with families, there is just as much, and this is not a criticism, it is just pointing to the facts from experience that it is only human nature to feel regret and fear when markets are falling and you're losing money. The paper value of your bank account is falling. But it is just as powerful when everybody around you sees their S&P position going up. And if you're sitting there in private equity and it's not getting marked up as quickly, you're gonna make bad decisions. And so the behavioral argument for private equity, in our opinion, doesn't hold. I've heard Cliff Asness make the argument that because of the smoothing profile of it, that you could actually argue for lower returns for private equity because it prevents people from getting fearful in the drawdowns. But there's just as much FOMO on the way up.
And you mentioned Leon Cooperman. I did that interview a couple of months ago. It was quite an honor. I believe Leon said my hour and 3 minutes was his longest digital interview by far he's ever done. Thank you, Leon. And by my standards, an hour is probably relatively on the short side. But he kind of more than hinted, and it's not theoretically incorrect, that hedge funds were a little bit hands tied behind their back over much of the last 10 plus years, in that interest rates, let's go with the verbiage, were somewhat artificially suppressed. And that made it harder for volatility, maybe harder to get alpha. Do you buy into that argument? And even if you did, is it now returning to more somewhat normalized rates?
No, I don't buy that argument. And look, I have a lot of respect for people like Leon, but I think there's the reality of there are so many things. The financial system's complex. The broader portfolio management industry is very complex. It is very easy to fall prey to headlines as to why a certain strategy or group of strategies deliver the results it did. And I think more often than not, it's just, headlines and it's not correct. Let me just add one thing, Angela. The thing I'll say is that there is a simple nature of markets in that this is true in public markets, it's true in private markets. The term we used to, when I used to be at Bridgewater for 5 years, and the term we'd use there is you have to understand what is the beta in the investment you're making and what is the alpha. Separate your alpha from beta. And it's just as true in that when you're in public markets, every time you make a buy, somebody's selling to you. Same thing in private markets. If you're buying, somebody's selling to you. Both sides of that trade can't be right. And it depends on the time horizon. And so the nature is that as the combination of buyers and sellers gets more sophisticated, the odds of being right simply fall. And so, when I remember this, CalPERS, there was a headline, CalPERS was going to start deploying into hedge funds. This was 2002 or 3. Dot-com bust had basically completed. We are near the bottom. And naturally, as is always the case, investors on average are backward looking. So they said, well, look, we've just suffered this huge drop in our asset base. Let's jump into strategies that worked during this last crash. And so the hedge fund industry was, well under $1 trillion at that point. And by 2008, it was 4 or 5 times bigger. And as a result, the industry as a whole was basically the market. And so to me, it's the reason why hedge funds underperformed was the simple reason that markets were more competitive. There's just simply more sophisticated buyers and sellers on each side of the trade. That's the real reason.
And I think back, and maybe I'm giving away my age, but the Wild West days of the 80s, the 90s, even the early 2000s, where I think I could make a stronger point against some of the things that you're saying, and that look at what David Swensen was doing. Look at some of the returns in the right venture capital, in private equity. Look at some of the hedge fund managers that were doing incredible, quote unquote, returns. What happened in the following decades where that simply became harder? Maybe as they got bigger, they became asset gatherers. They spent 3 months in a summer in the Hamptons. What was it?
That's right. Yeah, no, look, even David Swensen writes in his book. I mean, he's another person that, so many people respect and admire in this industry, and he contributed so much. But in his book, I forget the name, on portfolio construction, he lays out the math for private equity. He lays it out saying, like, once you account for the leverage, very seldomly does a private equity fund on a risk-adjusted basis outperform the leveraged equivalent of public markets. And that's why he himself, as the founder of that endowment model that relies, that today, naively in our opinion, relies so much on alternatives, even he was saying, don't do it. Just buy, a few ETFs, stay with liquid public markets.
And could you elaborate on how you believe a family office could effectively construct a portfolio?
Sure. Yeah. So, like I said before, every family needs to go about this in a way that suits their needs. And that needs is a very broad word in this context, but, really generally say with the family office, you're dealing with multiple generations. Each generation has its own needs. Maybe the patriarch of the family, that first generation, has certain cash flow needs as they are maybe in retirement and just living their life. Maybe the next generation, some may be involved in the family business, some may not, but they may be more risk averse because they weren't the ones who built the wealth. So every generation is going to have different needs. So you need to solve, the portfolio needs to solve for those needs. Along those same lines, every generation is going to have its own risk tolerance, and so on. And so you need to solve for those family-specific factors through asset allocation and strategy. And then from there, go along these lines of what we're talking about, which is you have to pick the right strategy and you have to avoid the wrong one, which is the big mistake of over-diversified with high fees. When it comes to picking the right strategy, you have to ask yourself, do we as a family, do the family members who are going to be managing the portfolio or hiring advisors, do we have an edge? Is there a corner of the market or type of strategy that we think we can outperform in because we have the experience or some special skill set or know-how where we can generate that alpha? If not, if the answer is no, it is a no-brainer. Index funds, a diversified portfolio of index funds, matched to all these family requirements of cash flow, risk tolerance, and so on. If there is a pocket of edge, then that's when we would say, look, you want to follow this focused approach. Don't go farming out the portfolio to 50 different alternatives managers, because like I said, you will end up, I've seen this too many times, you will end up with a market minus high fees portfolio. That math has not been wrong since Bogle laid it out in a paper, must have been 40 years ago. But yeah, follow that focused approach, figure out the corner of the market that works for you, whether that's public stock picking or private deals, or even look, if you want to do startups, you say that's your edge. Figure out what is the right portfolio construct for startups, because seeding startups is a very different game than picking large cap stocks. The successful approach to both requires different portfolio constructs, right? For large cap stocks, a concentrated portfolio, kind of like Buffett will say, you're never going to make a lot of money in your seventh best idea. While in seeding startups, you want to be very diversified. So you need to pick the right approach, but focus on where do you have edge, and then otherwise, build around family cash flow, income, risk tolerance requirements.
And before you get to the opportunity to talk a little bit about the literal portfolio construction execution, leading into that, I mean, how I was weaned in my work with family offices on the investing front, and we'll ignore certain things on investment committees, decisions, and all that, a topic for a different discussion. But I will talk about you need an investment policy statement. Depending on various trust entities, branches of the family, I could make a hell of an argument you technically need multiple. That then leads into effectively what's your asset allocation strategy. But maybe more applicably for you and your belief in portfolio construction, how simple, straightforward, or in some ways complex does an investment policy statement need to be?
Sure. Yeah. Maybe I don't want to spend too much time on this, but it can be very simple. I think to your point at the start of this interview, whether you have $10 million or 10 billion, the amount of money, in our opinion, doesn't change the investment policy statement on its own. It can be a few pages long with, basically a simple, hey, we're not going to make macroeconomic forecasts. We're going to broadly diversify. We need to meet a certain return hurdle and cash flow requirement. And we're going to achieve that with a small handful of positions that give us enough diversification. There's no reason why a multi-billion-dollar family can't do the same thing. There's no reason why it can't be that simple. Markets are liquid, and the products to access them are liquid and large and low cost. And it, like I said, I mean, the math is pretty simple. You will outperform 90% of your peer group just doing that.
Before we get to ideas on portfolio construction for, say, 15, I'm going to ask you about the 15. Now, maybe it's an arbitrary number to be a good clickbait title in the thumbnail on YouTube. Could I make the argument one of two ways? Actually, potentially, it should be less. When I look at certain 13Fs, speaking of hedge fund managers, often they're relatively concentrated in 3 to 5 and much more smaller allocations. Leon actually spoke about that in some of his picks in the program a couple of months ago that I did. Now, the converse of that, could I state that maybe 15 is a little too lean, and would I get value in diversification without making it more complicated going to, say, 30?
Yeah, sure. Yeah, no, let's talk about this. This is, I love this because I think way too many people are online talk about stock picks. And not that there's anything wrong with it, but to us, it's a little closer to investment porn. The most important topic is strategy. It's the strategy level conversation on portfolio construct. And there are just not enough people talking about this, in our opinion. And so to your point, look, it really depends on a family's goals. We see this all the time. You see certain wealth creators who are just like, they're still in this mindset of, I'm going to keep hitting it out of the park, keep generating more wealth. That mindset almost certainly requires the goal of outperformance and to outperform at public markets, you need to have a concentrated portfolio. It's like broadly competitive markets generally do a good job of keeping prices close to fair most of the time, not all the time and not perfectly, but enough so that you say opportunities come around not that often. So you have to take a concentrated portfolio. So it goes back to, that Buffett or Munger saying like, something like 6 stocks is all you need to be diversified. But that comes with a lot of lost sleep and a lot of stress unless you are living and breathing that portfolio. And so the other end of the spectrum, which is still a very smart portfolio, is to say, my number one goal is not to keep hitting it out of the park, but is to preserve what I have and still grow it at a good rate. And that requires diversification. Diversification, number one. And what is diversification? It's something like you're saying, Angela, like it can start with 15 to 30 positions. They don't all have to be stocks. It can be a mix of stocks, bonds, across sectors, across geographies. You just need to be modestly diversified enough. And where that comes from is that, you want to build a portfolio that's robust to a wide range of things happening in the world. And when you're a family that's going to be passing along wealth for a generation or more, you think about what has happened in the world over the last 50, 70, 100 years. You think Great Depression, multiple wars, the dollar losing 98% of its value relative to inflation, and gold and off the gold standard. You just go on and on and on. The advent of radio to the internet to now AI. You have to prepare for this much change in your portfolio. And so diversification is the key to preparing for all these sometimes crazy things that are going to happen.
That is true. Now let's get a little bit into what specific criteria do you use to select whatever it is, 5, 15, or 30? What level of sector diversity? Do you follow large cap, mid cap, small cap, micro? Walk us in a little bit through the process.
Yeah, sure. Yeah, no, this is, we actually don't use any of those layers. No, I mean, we, because myself and another one of our partners, we came from Bridgewater Associates. So we, they have a framework that we think is grounded in the most fundamental aspects of finance, which is that, if you look at the present value formula, but I don't want to get into the wonkiness of the formula, but growth and inflation surprises are the thing you want to diversify to. And there's a lot of ways to do that. But let me just talk through what I mean by that is that, let's take 2020. A better example is 2008, but any one of these surprise periods, the world is going along at a certain pace, economies are growing, and then there's a shock. And so that 2008 shock is a growth shock. Global economies have this contagion that leads to contraction, mass unemployment, defaults, and stock markets fall 50%. You can prepare for these growth shocks through diversification. One simple way is that what works during a growth shock is simply bonds, owning high quality government bonds. Now, let me just stop there for a second. Family offices hate bonds. And in the US, rightfully so, because you pay about half the returns away in taxes. But at least as a starting point, like when stock markets down 50% in 2008 or, 30 or 5 or so percent during the COVID crash, bonds were up. So they protected you. But that's not the only way to go about doing that. You can invest in what we call bond-like equities. So that can be companies in sectors that are more what we call essential service sectors. So that could be, people are not eating less food in a recession. They're not cutting their electricity, turning off their electricity in a recession. So like utilities and food staples, but also, in this modern age, what are the equivalents of essential services? It's like our phones and data in the cloud. are just as essential to the functioning of our modern economies as, say, food was 100 years ago, or food always has been. So there are bond-like equities, and there's lots of ways to define that are a more tax-efficient way to protect yourself against growth shocks. So that's an example of, think about diversification from the standpoint of growth surprises and then inflation surprises. When you look at, anybody who reaches out to us, we'll show you this data. If you look at the last 100 years of stock market returns, and you look at it decade by decade, the thing that surprises people, especially when they're in this stocks for the long run mindset, is that out of the last 100 to 120 years, so call it 12 decades, 1900 through 2020, 4 decades, there were 4 decades when stocks didn't lost money for 10 years, right? The 1930s, the 2000s, there were in 1970s and so on. So 4 out of 12 decades, a third of these very long periods of time, stocks lose money. And what is the simple driver of that is, well, one is if you start the decade at a high valuation, that inevitably leads to poor returns. But also when there's another shock during the decade, and one of those shocks is either a disinflationary, depressionary shock or an inflationary shock. So like 1930s, the Great Depression, that was a deflationary shock, the debt deleveraging. 2008 was the same, so the 2000s. But then the 1970s was an inflationary shock. Dollar going off the gold standard, the strong power of labor unions resulting in wage inflation, the oil embargoes, all of these things contributing to this inflation, which fed through to increased costs for businesses, lower profit margins, higher rates as a headwind. And so you want to think about diversification in terms of these economic shocks rather than, in our view, at the sector level or the country level. Now that macro framework is much more powerful than other levels of the portfolio, in our opinion.
But how about things like certain metrics, PE ratio, et cetera, book value, intrinsic? There's a variety of different things where even if you skew to being more of a value investor, there must be math that you look at to make a decision.
Sure. Yeah, no, absolutely. I think time and time again, every time we look at research, a new study we do, a new simulation, whatever it is, we are just constantly reminded that you cannot invest without paying attention to valuations. You just have to. And there's no ifs, ands, or buts about it. And so you want, basically, there's a, if you think about what is the magic formula to investing, it's very simple. Diversify modestly. Don't forget about valuation. That is it. And you could do that at any size and scale, and you can keep it simple, knowing just these 2 things. And so, yeah, absolutely, you have to pay attention to valuation. It makes no sense I think maybe that's what you're getting at, Angelo. It makes no sense to us to diversify, to say, 10 years ago or 10, 12 years ago, to say, I'm going to diversify out of my stocks to buy bonds yielding 1%. That makes no sense. I mean, maybe if the stocks were at a PE of 40, but back when they were 12s and 13s, it made no sense. Today, when PEs are high and bond yields are much higher, diversification makes a lot more sense. So you do have to take valuation into account when you're going about building these portfolios.
And you gave the example of certain decades that were very negative for stocks, and collectively from the crash in 27 through, I believe, the early 60s was effectively a net negative. Now, again, a little misleading because you're including the horrific year of 1927. Take that out. Some of the math changes to some degree. But again, if you're believing in a concentrated portfolio, even 30 stocks plus whatever residences, cash, what happens if we have a massive deficit, we have some issues of interest rate and inflationary concerns here in the US, we have massive political unrest. Like it's not assured, no matter what the math may look like on some early valuation of stocks, that the next year, decade, 20 years collectively is going to be good. We have seen periods where it wasn't.
Yeah, this is a great point you bring up. I love this because in the same way that people talk a lot about stocks, the other thing that people love to talk about is macroeconomic forecasts, which in our view have very close to zero value. It is, and there's a very important distinction here in that it is very important to take stock of the state of the world. Now, I'll give you a couple examples, but it is very important to not trip over the line of going from, hey, I understand conditions, to then tripping over and saying, let me use that to build a forecast to then inform my portfolio. So, for example, everything you just said, Angelo, I think is like really important to know today. It's important to know that U.S. debt to GDP is over 120% and at one of its highest levels ever. But it's also important to know that most governments around the world have debt levels that are higher than they've ever been. Like Japan's in the 200%. That we saw with the 2023 mini banking crisis that the financial system is fragile and that it is constantly going to be in need of rescue, and that we live in a super interconnected world, both because of the internet, global trade, and so on. That the risk of contagion in financial markets just keeps growing, and the fragility of the system and debt levels only contributes to it. That the greater the complexity around you, the more valuable it is to have that simple, understandable portfolio. Because when you have a complex portfolio, that's another way of saying, I don't really understand the risks. I don't really, like if I have a diversified portfolio of private equity funds, I don't really know how much leverage I have in there. I don't really know exactly what I'm exposed to. But if I have a portfolio of 15 to 30 positions, whether that's public stocks or some mix of private, let's say 30 positions, stocks, bonds, everything, I know exactly what I own. If it's public markets, I get a lot of transparent reporting. I can really deeply think about my risks. And I'll just touch on something that we love to use as a tool, and maybe we can talk about it some more, is we like to use something called replication as a strategy and as a tool, partly as a thought experiment to thinking about our risks and being able to see around corners. And really it's preparing for uncertainty.
Interesting. So moving the conversation around a little bit, I believe it was a Camden research study, and admittingly, maybe it's a closed group of groupthink-like families that are doing similar things, but I believe there was actually more allocation to private markets, like 27% in private companies compared to like 25% in public companies. You and I may scratch our head a little bit. Maybe those families are incredible insiders and they know what we don't know and are getting incredible quote unquote alpha and worth it, the illiquidity premium. But if you're thinking that perhaps families are opening up to liquidity and transparency, to the realities of the market, at least the last 10 years in public, there appears to be certain segments, maybe pretty strong ones, of the family office community that are saying, no, there is still value, even with illiquidity, even with me not having maybe the full picture. And now, again, I gave an example of the Hamilton Lane where certain things could get skewed and you need to think a little deeper and think for yourself. But how would you respond to that? Are families having an edge that we just don't know? Or are, I'm going to be careful with the words I choose, they're overcomplicating things? How about that?
Look, I mean, I think there's a lot of reasons people invest the way they do. But, look, we see this even with the families that we work with. There is a certain aspect of doing these deals, having the private companies. If you're retired, it gives you something to do. It's something to talk about to friends, that kind of thing. But that doesn't mean it's necessarily going to outperform. I think, just touching on this replication thing, what we love to do is, this idea of replicating a manager, basically copying their holdings, you can do in private markets too, which is surprising. But say with public markets, everybody knows that these managers, they have to report their holdings through 13F filings. And so, if you have a manager that you have high conviction in, you can copy them. We do that, and I think it's a great strategy. But as a thought process, as a tool, I think it's really powerful in private markets. So I'll give you an example of something families families can do. But let's suppose a family said, look, we want a 25% allocation to private equity, and we need to build that up. Now, look, you and I, Angela, are going to recommend against that based on everything we know. But let me give you 3 ways you could think about getting that exposure, but without the complexity of capital calls and trying to line up vintages and all this kind of stuff that comes with private equity. Is that one, you could say, how else can I get private equity exposure through public markets? Well, what if I bought shares of Blackstone and KKR, the big behemoths? Their portfolios across their $1.5 trillion or so dollars that they now manage basically represents a huge chunk of the entire private equity universe. So owning those companies, you own the fee stream that they're charging you. Now, the other thing that's interesting,
pretty good business the last couple of years.
The other thing is, right, we know that private equity, at least according to the data we see, has barely kept up with the S&P. But Blackstone and KKR stock has outperformed. So you actually outperformed by owning the fee stream than participating in the deals. So that, I think that's one smart way to play, participate in private equity. Obviously, to your point before, Angelo, about valuation, you need to pay attention to valuation when you buy those stocks. But there's enough public market info out there to help you assess. Another way is to look at what are some public companies that are following a private market strategy. So you take Berkshire Hathaway, or one that not everybody knows about, but that's coming more into the mainstream, say the Constellation Software.
Yes.
These are 2 super well-run businesses. Now, finds Berkshire's a behemoth and all that stuff, but, that have also done really, really well for a long time, that you get the liquidity of public markets, you get transparency, but they're following a similar private market strategy, but without the fees and complexity and reporting issues and tax issues. The third is that you can just look at the exposure and say, what does a broad private market exposure give you? Or whatever it is that you're trying to achieve, whether it's a diversified portfolio of private equity funds or deals in a certain space, and say, well, let's suppose, for example's sake, I'm trying to get exposure to the private equity universe. Well, we know that whether I buy the local hardware store or shares of Home Depot, I own hardware businesses, home hardware. Well, it's the same idea with private equity. If I own a bunch of smaller leveraged businesses, well, I can buy the equivalent in public markets, whether that's small cap or some leveraged subset of small cap companies. So we would think about going down these paths first, at the very least as an evaluation tool, if not even better so, as a way to implement that exposure rather than buying into the complexity.
Very good points. Do you have a specific opinion about public REITs?
It's a good one. No, I don't. Nothing really to add there relative to, other experts in the space.
And a little bit outside the talk, but I think fits in it, gold, and maybe more applicably for you with public companies, gold miners.
Oh, sure. Yeah, no, this is an interesting one. Gold is very much a love it or hate it asset, and we work with families who love it and find it a necessity as part of a portfolio, and others who hate it. And, it doesn't need to be in everybody's portfolio, but the role of gold, and then through that gold miners, is as just a hedge against everything else breaking down. Like if you look at the long-term history of gold, it is a 0 return asset net of inflation. Now that's better than cash. Like cash in the bank has lost most of its value because of inflation, so it's better than that. But bonds and stocks, as long as the expected returns are positive above inflation, should do better. But and so then in turn, if gold is a hedge against chaos, gold miners basically with their balance sheets as inventory of unmined gold under the ground, they're like a leveraged play on that. And because they're a business, that you could argue they're a little more of a tax efficient, cash flowing way to own gold, who some people think is actually cheap today.
And do you have any specific opinion? Would it make your 5, 15, or 30 a Bitcoin ETF spot?
Yeah, no expertise there. I'll just I'll go with what Peter Thiel said in a recent interview where I think he has sold most of his Bitcoin now that the retail inflows have happened. So I'll side with Peter on this one.
My little insight relative in the world of crypto: be careful of what people say. It may be different than what they actually do.
Got it. Okay, good to know.
It's a little bit out there. It's probably more macro-ish, but my audience knows I enjoy to interview macro strategists, economists. Dollar denominated. Basically, dollar is king. The world kind of settles in dollars. That's getting a little weaker and a little weaker. Not to ask you for a macro prediction, but if I'm a family office, should I have some concern if 97.9% of my portfolio is dollar denominated? Should I look deeper as well into my stock portfolio to see if they have an increasing percentage or ratio of international dollars, quote unquote, outside of the U.S. interest expanding?
Yeah, this is a great question, and I've learned the hard way. Being at a big macro hedge fund like Bridgewater makes you think that you can make macro bets and predict what's going to happen in the future. And the biggest learning coming out of a firm like that is that nobody knows what's going to happen, and you don't want to invest in strategies that make big macro bets. You certainly don't want to make them in your own portfolio. But the biggest takeaway from that is if you can't predict the macro future, but you're taking stock of current conditions, you know what to prepare for. That's the importance of bringing up the scenario you just brought up, Angela, which is we agree. Like when you have a currency of a country that is as indebted as we are, that at current levels of interest rates is headed to basically our government is Ponzi financed at this point, right? It's the higher interest rates.
Yes.
Now they're falling, that we need to borrow money just to pay our own interests. If that continues, it's inevitable that the dollar keeps losing value. And so as a family trying to preserve wealth, pass it along to the next generation, you need to diversify to that scenario. And there's a lot of ways to do that. You can, since you asked about gold, you can own things like gold as a hedge against that, because gold has this, multiple 1,000-year track record of preserving purchasing power. You can look to diversify into things like hard assets, whether that's natural resource assets, but also, like you said, you can look at companies and say, where are they doing business? Are they global? Which, the nice thing with owning, whether it's index funds or a few large cap companies, is that by and large, their sales are global, whether it's a Coca-Cola or a Microsoft. So it's not hard to be globally diversified, or even, more, kind of call it macroeconomically diversified. But I think going back to your question, it's really important to think about those scenarios and ask yourself, are you prepared for it? Not necessarily taking a view on it and taking a bet, but are you prepared, and how are you prepared? That's what we would say.
And we did hint at it and go down this road a little while ago on diversity. And I'm going to try to formulate this into a question. We kind of believe that being concentrated is one way to get rich, mainly perspective of our own company where we have interest, quote unquote. We're led to believe that diversity is a way to stay rich. And we could find people that could go on both arguments. And even Charlie Munger has basically said something to the effect of, I'd rather have an intimate basket and watch it very, very closely. So kind of when is too much diversity? Before you answer that, and I know my audience has heard this before, it does nothing but get me in trouble, but I'll mention it anyway. Don't forget, Bill Gates could have been the first, as we know it, on paper trillionaire. Now, let's ignore the fact doing good things via a foundation, but if he simply didn't listen to Warren, didn't diversify, and he was more concentrated, could I make the argument, I don't know, him, his advisors, his family office, I know the audience is going to kill me, they kept him from being a trillionaire. Did they really hedge his risk that much?
Yep. Yeah, no, I mean, you're hitting on the key trade-off with diversification. And this is, when look at it, everybody hits this threshold at a different point, right? For some people, getting to $5 or $10 million, you say, oh my God, I do not want to lose what I have. Diversify. But like we talked about, the worst thing you could do is diversify in a way that leads to unnecessary complexity, high costs, and through that, a ton of tax inefficiency. That's the worst thing you can do. But if you diversify, well, in a way that let's say it's buying a few index funds, like a global stock portfolio, some natural resources, or some REITs, and then some gold and bonds, something like that, and it's all through low-cost ETFs, that is a good form of diversification. It's not the 50 hedge fund strategies where you don't even, it's hard to track what you own, or, that kind of thing. So, but as you're alluding to, Angelo, that comes with the trade-off, which is it's not going to keep up with whatever the best performing asset is in your portfolio, and certainly not the best performing stock within is one of those index funds. So there's always a trade-off. And the flip side is, look, it's, people forget, and I remember this very clearly because I'd left Bridgewater, was just about to start Greenline Partners. And I remember looking at Microsoft stock and saying, Steve Ballmer was the CEO. Nobody had heard of the cloud before. All the headlines were that Microsoft missed mobile, had made a blunder on acquiring Skype. Windows was losing its prominence as a platform. And so Microsoft was trading at a 7 times PE net of cash. There was no guarantee that Microsoft was going to be the $3.5 trillion company that it is today. That it's easy to say that about Bill Gates now because of Microsoft's success, but if it hadn't reinvented itself as it did over the last 15 years, we'd probably be, maybe Bill Gates would have been thankful.
Money putting me in my place, of course. I'm putting a little bit words in your mouth, but as you were a couple of minutes ago describing some of your portfolio construction ideas, I'm going to say that you're probably more of what I would consider value-centric versus growth. Maybe I'm wrong. Now, here's my more specific question to you, but you could feel free to comment on that, is what exactly is, and I'm being a little bit of a wise guy, what exactly is a value stock? I look at it as I want to buy a good company, of course, at a good price, but more importantly, I want to buy a good company that I believe is going to grow moving forward. And why do I want to be limited by so-called growth or value?
Yeah, look, I actually completely agree with you in that the moniker, my personal bias is to lean on the value side, but I completely agree that the moniker of value stock or value investor or growth stock or growth investor is totally wrong in that, what is a value stock? It's any business or any position where you can buy the future cash flows on it for less than its present value. That's value. That's buying something for cheap. And that could be, if NVIDIA is going to keep growing at 30% a year, a PE of 60 might be cheap versus, let's say, Verizon, let's say they're not going to grow at all, then a PE of 15 may be expensive. And so it's just, are you buying the future cash flows for cheap? The problem with both styles is that value investing tends to buy slower growth businesses, and there's always the value trap of one that's in decline permanently. And growth has the opposite problem where the rate of growth rarely continues because competition enters the space and stuff. So more often than not, growth investors end up overpaying. So both styles, as traditionally defined, have their flaws, but in the end, really, all you're trying to do is buy cash flows for less than they're worth.
Indeed. As you mentioned several times, you were at Bridgewater. Bridgewater is an iconic organization here in the great state of Connecticut. Obviously, Ray Dalio, speaking of macro and some of his opinions and thoughts, he wrote some incredible books on principles. What were some lessons that you learned? And you actually hinted at one or two of them already, but what maybe stands out to you that my listeners and family offices could learn from?
Yeah, sure. One of my favorite stories is, when you like you said, when you think about Bridgewater, you think of macro, the views that are in the press and on LinkedIn, and these forecasts and views. But inside the firm, the thing that people don't know is like people like Ray would walk around and say, he who lives by the crystal ball eats glass. So they were one of the first who would say it is so dangerous. You have to be so careful when you are managing money based on a forecast. It is far more reliable, far better to prepare for an uncertain future rather than to make a bet about the future. That is actually, ironically, it's one of the biggest takeaways from one of the best macro investors.
And some people may be listening to or watching our conversation and say, man, this Maneesh guy, he's anti anything that isn't stocks, bonds, or let's say cash. And I'm being maybe generous on the bonds. How would you, what would be your response to that?
Sure. Look, I mean, there's an element of truth in that we really believe in simple is better. Simple more often than not beats complex. But just to be clear, what we're not saying is don't ever do a hedge fund, don't ever do a private deal. That is not what we're saying. We're just saying that, one, the worst thing you can do is over diversify and pay high fees. Two, if you are going to take the complexity, tax inefficiency, or tax loss of tax control from hedge fund or private equity, first, as part of the analysis, as part of the due diligence, do the thought exercise of how else could I get that exposure? How could I kind of replicate it? I'll give you another example just because maybe your listeners will appreciate this. I remember about 10 years ago that the venture capital industry, we both know, goes through its cycles. And, the hot venture investment and venture theme about, you might remember, Angela, but maybe 10-ish years ago was direct to consumer brands. And so, Warby Parker was developing its name, Casper mattresses, things like that.
Mm-hmm.
And, so a lot of investors were piling money into venture funds who were then investing direct to consumer. And the thing we realized, we said, what is another way to get that exposure? Well, a huge amount of that venture money, ironically, because they were trying to build brands through online advertising, were ending up as revenues and profits at Google and Facebook. So you're like, a better way to play that theme was just on Google and Facebook. And, so it's just like going through that type of thought exercise. And, you could do the same thing today and say, okay, look, there's tons of venture money going into any startup that has the word AI in it. Well, who are the picks and shovels providers to the AI companies? It's the cloud providers, Google,
that is the
Microsoft, and then of course, the NVIDIAs and the chips of the world. That might be, a better way to play that. But again, go back to valuation and make sure you're being sensible there as well.
And I suppose I have to bring up, my audience is expecting it, where we'll probably definitely have a disagreement, and let's see where it goes. I have been on record, based on my decades of experience in traveling the world, that dynastic wealth, that building and maintaining a family empire, commonly, not all the time, commonly is going to come from the ownership and controlling ownership of a private company. Of course, it could be one that was founded by that person or family. It could also be like Elon with Tesla, where you're buying it. My points are going to be control, and here's the big one, engaging the rising generation, how the world really works. How do you source deals? How do you negotiate? How do you do initial diligence? How do you come to a price? What kind of financing? How do you do further diligence? How do you understand management, hiring and firing, making tough decisions, failing? I think these are things that are hard to learn in school and kind of hard to learn in public stocks. Do I admit that is more illiquid? You bet. Is it more concentrated? Sure. But as we discussed, in some ways that might be good. Am I recommending 100% of the allocation like that? Probably not. But to just assume that my family and my generations are going to be fine, where passive as passive could be, I don't know. I'm just not really seeing that when I meet multi-generational dynastic families.
Yeah, I mean, I think the thing that we see, and you probably see the same thing, is that, for every, call it centimillionaire and up family, there are only a small handful of family members that are inheriting wealth who are interested in whether it's the family business or managing the money. And so, if the family office splits up with each generation, there's going to be certain family members who just say, I want to go, do my job or do my hobbies or whatever it is they do, and hire an advisor. So with those people, what they need to be careful of is making sure they hire an advisor that's aligned with them, that follows this kind of simple approach that's focused and helps them, that is aligned with them and helps them preserve that wealth and grow it at a modest rate. For those family members who are, interested in getting engaged in the business, then it's a totally different story. And I think to your point, it's like if they want to grow that wealth like their previous family members, and they're going to have to, in a way, do what their parents and grandparents did, which was take risk, build businesses, and so on. It's that's going to be, in our view, probably more the route to a new level of riches than, say, spreading your wealth across and paying 2 and 20 to a lot of private equity managers.
You mentioned Berkshire a couple of times, of course, a darling of value. Warren, of course, is a legend.
Yeah.
What happens when, who knows when Warren moves on? Are you going to have to reevaluate immediately? Are you going to sit on it for a year? What's the succession plan? But there's only one Warren Buffett.
Right. Yeah, no, that's right. And I think Charlie has commented on this, and I think I think Warren's done a good job of getting his shareholders ready for this, and that if he dropped dead tomorrow, he's made the point that he thinks Berkshire stock will actually go up. It'll pop because he's holding on to all this cash, which I think it's approaching $300 billion in cash at the moment, in part because it would be an estate tax liability for him, or at least it's an unnecessary tax bill for him. As soon as he passes, he has a great stable of next generation managers who can pay a special dividend and reduce the headwind that they may have to face from just having to reinvest so much cash. But I think by and large, shareholders who own Berkshire, who have been following the company, are very comfortable with the next generation of management. And there's probably many decades to go before you have to worry too much about the fortress that is Berkshire.
On Warren's marital status, estate planning strategies, if they were to need to liquidate from a public company that could cause the markets to move and cause issues, going into cash now could potentially avoid that somewhat. Now, he may also be looking to give 95% of his money to quote unquote philanthropy, and then the estate planning issue, liquidity, won't be an issue. Although you could argue at his net worth, even 5 or 10% could be an interesting and a large number. Not sure I perfectly buy that, Maneesh, but I hear you. And that actually, you kind of beat me to the punch on the next part of that question. Whoa, he took a big amount off the table at Apple and a moderately big amount by his standards at Bank of America going into cash. Should we be concerned? What does he know that I don't know?
Sure. Yeah, no, I think it's a really pertinent question today, with, when we look at markets and look at valuations, the S&P is trading at a trailing PE of something like 27. So that is, while the trailing 30-year average is more in the 18 to 20 range. So just on that simple measure alone, the market's something like 35 to 50% overvalued relative to historical average. Now, we don't think it's that extreme, but And then when you look at growth stocks and their PE, like the average PE on the Mag 7 is something like 40.
Yeah.
That's very high. And the premium you're paying in growth stocks relative to value is also now again at an all-time high. You know, at similar levels to where we were in 2021 before the crash in 2022. And so I think what what Buffett is doing with the Apple trade is the following: is that he bought it at a PE of around 10, somewhere in that low double-digit range. And what was going on then is, one, you had a business with massive profitability and the ability to return tons of capital to shareholders. And so even if Apple didn't grow from that point, they were buying back 5 to 7% of their stock per year. I think that's what Buffett was really betting on. And so not only did you get growth, but you also got a huge return of capital through buybacks. So you don't get it as a dividend, you get it through buybacks, but it has the same impact. At a PE of 10, if you're getting 6-7% return of capital per year, that's kind of the same as getting that much growth. So you could justify that, hey, that thing was probably 50% undervalued. At a PE of 35, which is where I believe Apple is today, that same level of buybacks is a return of capital of 1 to 2%. And if the stock is overvalued, then they're actually buying back expensive stock. So you have this kind of potential double whammy. So when it was cheap and you're doing buybacks, you get the double compounding benefit on the upside. And now it's reversed. So I think it's probably just reacting to prices being high.
Indeed. And audience, we probably have about 15 or so minutes left. I have some great questions. Some of them are even going to be more company specific, although Maneesh has been pretty open relative to Apple there, Berkshire, a little bit of Microsoft before. So stay tuned. That is coming. But one or two brief notes. First of all, understand this is for entertainment purposes and our perspectives at the moment. Conditions change, therefore opinions could change. You all have different risk tolerances, different cash needs, and different goals. And that could impact in terms of what you're investing. So at the end of the day, do your own diligence, make your own decisions, and effectively think for yourself. Because when you invest, you can lose money. Also, on that cheery note, I did want to note something more positive. And we have some new folks that I have coming on today to the live stream. Welcome. I hope you're enjoying it. We open these up sometimes a little bit more to the public, but they're really focused on live and in the moment and interaction with our members that get my in-person events, my 100+ private digital programs that are long form and intense and educational like this one, my proprietary written content, some level of masterclass, best practices, and kind of helping you. A member called me today, connect the dots and help out with the strategic introduction or a little guidance on the phone or any way that I could be of value. Go to angelorobles.com and join. Be a part of my private club, SFO Continuity. It is effectively conflict-free, very intimate, and a private club dedicated to deep intellectual thought and peer-to-peer connectivity, truly peer-to-peer, digital and in person. Couple of questions as we take it to the home stretch. And if you're uncomfortable being a little more specific about companies, but you have been pretty open so far, it's your call. So in the Mag 7 is, of course, Meta. You kind of mentioned them as Facebook before in the past. Zuckerberg is an iconic entrepreneur. He almost appears to be reinvigorated. They're doing very intriguing things. They're playing a lot of catch up and doing very good on AI. They got their new glasses and all these things coming out. Yeah, I'm definitely not going to classify them as a value, but how do you look at them? And for certain families, may they make it into a top 5, 15, or 30 in a portfolio?
Sure. Yeah. I'm not going to comment on Meta specifically. Definitely don't have an edge, relative to anything you'd read out in the market. Let me make a comment relating to them and some of the other Mag 7 as it relates to AI. There are a lot of reasons why investors have rightfully concentrated in some of these big names. They are effectively staples of our economy. You just can't find anybody in America who's not using basically most of those companies, on a day-to-day basis. Apple phones and Microsoft powered computers and, Amazon for a range of things and so on and so on. And so you get that aspect of they're just in everybody's lives. They, for the most part, generate very high profit margins that they are then returning those excess cash flows to investors. And they've been growing, and the growth seems to be continuing. And in some cases, crazy enough at their size, is accelerating. The one thing that we are paying very close attention to is that these, call it high profit margin, high growth, call it capital or compounder stories. If AI continues to be as capital intensive as it is today, might completely change the economics of some of these companies. And I think that is something that investors need to really pay attention to. Because if you go from capital light compounder, where you're able to return a lot of capital to shareholders and easily invest in your growth, and switch from that to needing to reinvest a ton of capital and not able to return it to shareholders, that changes the economics of these businesses and therefore the valuation they deserve. And there's too much uncertainty around that right now, I think, to predict where that's going to go. But I think it's something that investors need to pay attention to.
Is there a firm in the Mag 7, and the one that's been on the top, 20 for decade after decade after decade, is Microsoft? Is there one in the Mag 7 that stands out to you from your perspective as more likely to, let's go with the word, make your cut?
No, I couldn't pick one. I mean, it's I couldn't pick one. I'll just maybe repeat something that Charlie Munger said, before he passed away. Somebody asked him, something about constructing portfolios and picking stocks, and he admitted, he said, given how important these companies are in the economy and the innovation they're contributing to it, the role they play in everybody's lives, it's very hard to own a portfolio without at least owning some of those companies. But at the same time, when pressed and said, well, why did you buy Apple? He said, because it was the only one that was cheap. And so, they made literally probably the most profitable trade in history. I think they put in $40 billion into Apple, and they held on to it until it was worth $160 billion. So they made $120 billion on a single trade because they had the discipline to wait. And this just gets back to, I think, everything we've been talking about today, that if you're going to go simple in index, it's a totally different story. But if you're going to go simple and focused, we didn't talk too much about this, but it requires an immense discipline that just most investors don't have, and you don't really appreciate until you try to do it yourself.
Yeah, the fact that we could simply look at our phone, aka a screen, and trade in and out. It's different than it was back in maybe the late 80s and 90s when I first started. It was a little too hard. I couldn't be so acting on my emotions, for lack of a better word. If you're willing to share, I think it would be valuable for my audience. Is there, besides a little bit of your overview on Berkshire and one or two others, is there something that you believe, from more of a value perspective, is a somewhat underappreciated stock that maybe families could learn a little bit something about and do their own thinking and their own research?
Yeah, sure. I mean, I'll throw out a name. I think, again, like you previewed this part of the call with, this is in part for fun, but I think also when we talk to families about building this more focused portfolio construct, you hit the nail on the head, Angelo, that to stick with it, you have to do enough research on the construct itself to get comfortable and say, we are going to stick with this for the long term. And, because in the end, it's the family principal who in the end is going to make the final decision, whether that's hire or fire the advisor or buy, sell the holding. that the family itself has to do enough research with the help of advisors to say, can we really stick with this position through ups and downs? So I'll give you an example of a company that is a huge leader in its space, but it's very volatile because it's a smaller kind of mid-cap company. But so Credit Acceptance Corp, it is a deep subprime auto lender, something like a $6 to $8 billion market cap, but trading at effectively a price to normalized earnings of something like 9 or 10. But it has the economics of a big tech company, returns on equity of 30 to 40%, very profitable. And so, this a little bit ties to when we were talking about private markets, and that what is the role this company plays. It's a lender to people with poor credit scores to buy cars. Well, is that really that different than private credit? No, this is just a business that you can buy in public market form that doesn't pay a dividend. It has probably the single best stock buyback record we've ever seen. And where they have built out an edge in their space is that they're the single largest subprime auto lender. So they have this huge economies of scale in the space, but they have built an alignment between themselves and the used car dealers that source their loans from them, so that they're not only making bad loans, the dealers are incentivized to source them better loans because the dealers share in the profits. And so that the combination of the economies of scale, the alignment with their dealer partners, and lead to this amazing economics from a position that's so volatile, or is volatile enough that I think a lot of people don't understand it, and leads to this low valuation multiple, especially in a time when people are worried about a recession, and therefore people with poor credit scores being squeezed the most.
We're told that retail is bad, yet Abercrombie and Fitch, post kind of during COVID, not as much this year, has done incredible. Energy drinks, again, a little bit prior to this year, have done, what's better than incredible? Phenomenal, like Celsius. Have you looked into, if not those companies, let's go with the word sectors, or maybe specifically those companies, and asked why, and is that going to continue?
Yeah, sorry, I don't know any of the specific companies that you mentioned, but what I'll say is there's a book, and I'm forgetting the author's name, but it's called 100 Baggers. And the author, Chris something, he is now a portfolio manager, so you can reach out to him. But the book basically mentions companies like Monster Beverage and some of these businesses that have become 100 baggers. And it a little bit gets to, if you're gonna follow this focused, simple approach to investing, it doesn't require that you hold the biggest blue chip names in the world. There are companies that keep up and outperform the big the magnificent 7 tech companies that are just totally off most people's radar. But like a Monster Beverage, they for decades have had this, all the things you love about Microsoft or Apple, a company like Monster Beverage has had, steady growth, high margins, reinvesting in their business profitably, all that stuff, and just in a business that nobody talks about.
100%. And that was another company that I was going to bring up. A lot of people, how I phrase it, I guess the answer, and maybe it's changed in the last year, but since 2004, which stock has performed better, Domino's Pizza or Google? Now, it might have changed in the last year, but overall in that 20-year window, as far as I know, you could tell, or I wouldn't have asked it, the obvious answer by a small margin is Domino's. And other stock that those of us that travel in our car and want to enjoy a good steak, Texas Roadhouse, including this year, has done phenomenally well. I don't know if you look at food sectors or any specific opinion. Is that value? Is it's definitely not growth, or maybe it is? Have you looked into some of those other outliers like that?
No, none of those specifically, but I think, just because this is fun to discuss, but I think it's a perfect example of why a focused portfolio, like a simple focused portfolio, can work so well. And that, when you have, say, something like 3,000 publicly traded stocks and so many more private businesses in the US, and then you add stocks outside of the US, you have, say, 10,000 different companies to pick from. If you have a billion, let alone 100 million, there's no reason why you have to your universe has to be, large cap companies. But two, if all you need to find is 15 to 30 positions out of a universe of 10,000, even if markets overall are expensive, it doesn't mean, if you're patient enough and disciplined and do your research, and again, with the help of the right aligned advisors, that you can't find, a small handful of these companies that are, going to outperform. And, and look, it'd be very one-sided to make you think that, we're going to find the next Texas Roadhouse or Domino's or Credit Acceptance. But, the reality is when you're, call it, taking bets, like building a focused, simple portfolio, you're going to have losers. Everybody's going to have losers. But it goes back to that big idea of avoid the big mistakes. So, in a portfolio, you're going to have winners. Don't trim them too quickly. You're going to have losers. Let them compound themselves out of existence. And, if you're not too active and you follow the right portfolio construction and sort of buy and hold strategy, even in a portfolio with, plenty of losers, you will, you'll do really well.
Well, I'm definitely going to have to check out this 100 Baggers. That sounds like a great book and interesting guest. And I always thought, depending on, again, your risk profile, obligations, if you're younger and you're putting in the work and you have sometimes, again, too much money could be an albatross in its own way. Could you get, quote unquote, 40, 50% returns in the public markets? The answer is you could. Is it hard? Of course it's hard, for everyone would be doing it. But among the 3,000 that you noted, you can't tell me that, I don't know, 3% of them are going to have wickedly incredible returns that are going to be outsized. And they're probably not necessarily so obvious. So that whole thing, that whole exercise, I find to be intriguing, which actually is more impressive for Berkshire and others. They have just so much money. They may come across things that they think are incredible, but it's just not within their thesis and too small to kind of move the needle. But all of you out there are not Berkshire. so potentially it could. Maneesh, I do want to be respectful of your time. If you had a closing commentary for our investors and family offices could learn from, and then if you don't mind, share how people could learn more and reach out to you.
Sure. Yeah, no, I think I'll just remind everybody that, the real secret to building a great portfolio and a great family office is build the strategy around this idea of avoid the big mistakes. And you'll avoid those mistakes and you'll capture the upside along the way. And so if, we've written lots of papers along these topics and we're more than happy to discuss it with anyone. But if you'd like to reach out to us, you can reach our team at info@GLinePartners.com.
And do you have a LinkedIn profile? Could people learn more about you on that?
We do. Yeah. You can look up myself and Greenline Partners and our team on LinkedIn as well. Thank you.
And Maneesh's last name, by the way, is Shanbhag, and first name, Man as in Nancy, Eesh. I've known Maneesh for years. I highly recommend, at minimal, you follow him on LinkedIn. Maybe go to their website, learn more, have the opportunity to interact. The more smart people we connect with, the better. You may disagree, and that's okay. At the end of the day, think for yourself and form your own thesis, but you need to have some of the right inputs and possibly some inputs that in theory you would disagree in, because again, it helps you kind of first principles thinking and think for yourself. So everyone, I'm Angelo Robles. I hope you enjoyed it. Go and follow me on YouTube. I got the king of the monikers for Family Office. I registered it years ago at Family Office. I also have At Family Office TV, again, Apple and Spotify via podcast. I technically have a Rumble account. I may start to do occasionally some proprietary things on there. That's probably under my name or at Family Office or something, but you could find it. And again, those that would like to take it a step further, be an active member in my private club. And there are some selective consultative and other relationships around the world that I take on. Simply go to Angelo Robles, my name, ROBLES.com, and have a chance to learn more about what I do. And anyone could have an opportunity to reach out. It's my honor. I appreciate you listening, watching, and I get to learn so much from all of you. I hope you all enjoyed it. I really enjoyed today's session. It was a lot of fun. And I look forward to the next one. But this has been a busy week. It's like every month is busy, and I keep on having great guests on. I've been very, very fortunate for me to learn, and hopefully many of you as well. Maneesh, again, thanks for being a great guest and audience. Love you all. Thank you so much.
Thanks, Angelo. Good to see you.
Pleasure.